What if I told you that most investors underperform the market, not because they're unlucky, but because they try too hard? Seriously. They chase hot stocks. They panic when prices fall. They overtrade, overthink, and overpay in fees. Meanwhile, there's a simple, low-risk investing strategy that quietly beats most people's portfolios over time, and it doesn't require being a finance genius. Today, I'm going to break it down step by step in plain English, especially if you're a beginner. No hype. No get-rich-quick nonsense. Just a strategy that actually works. Why most people lose at investing. Before we talk about the strategy, let's understand why most investors fail. Here are the 3 biggest mistakes beginners make. Mistake number 1, chasing winners. People buy stocks after they've already gone up because they're afraid of missing out. By the time they buy, the best gains are often already gone. Mistake number 2, panic selling. When the market drops, fear kicks in. People sell at the worst possible time, locking in losses instead of letting investments recover. Mistake number 3, trying to beat the market. Most people think they can outsmart professional investors with teams, data, and experience. The truth, even many professionals fail to beat the market long term. So what's the solution? Instead of trying to beat the market, you let the market work for you. The strategy, simple, low risk, and effective. The strategy is called low-cost, long-term index investing. It's not flashy, but it's powerful. Here's the core idea. You invest in the entire market, not individual stocks. You keep costs extremely low. You stay invested for many years. You don't panic when markets drop. That's it. This approach has beaten the majority of individual investors over long periods, not because it's aggressive, but because it avoids the mistakes most people make. Let's break it down. Step 1. Invest in the whole market. Instead of trying to pick winning stocks, you buy index funds. An index fund owns hundreds or thousands of companies at once. For example, a total stock market index fund owns nearly every major company. An S&P 500 fund owns the 500 largest U.S. companies. Why does this matter? Because if one company fails, it barely affects you. If the economy grows, you grow with it. You don't need to guess which company will win. This instantly reduces risk compared to owning just a few stocks. Keep costs low. This part is huge, and most beginners ignore it. Every dollar you pay in fees is a dollar that doesn't compound for you. High fee funds, trading commissions, and frequent buying and selling quietly eat away your returns. Low-cost index funds often charge less than 0.1% per year. That might sound tiny, but over decades, the difference can be massive. Low costs, more money staying invested, better long-term results. Step 3. Use time as your superpower. Time is the most powerful tool beginner investors have. The longer your money stays invested, the more compounding works, the less short-term volatility matters, the higher your chances of success. Here's the key mindset shift. Short-term drops are normal. Long-term growth is what matters. Markets go up and down every year. But over long periods, they've historically trended upward. The investors who win are the ones who stay invested, even when it feels uncomfortable. Step 4. Automate and stay consistent. One of the smartest things beginners can do is remove emotion from investing. How? Invest a set amount regularly. Don't try to time the market. Treat investing like a monthly bill you pay yourself. This strategy buys more when prices are low, buys less when prices are high, reduces stress and decision-making. Consistency beats cleverness. Common questions beginners ask. Isn't this boring? Yes, and that's why it works. What if the market crashes? Crashes are temporary. Selling makes losses permanent. Can I still invest small amounts? Absolutely. Starting early matters more than starting big. Do I need to watch the market every day? No. In fact, watching less often usually leads to better decisions. Final thoughts. The low-risk investing strategy that beats most people's portfolios isn't about predicting the future. It's about owning the market, keeping costs low, staying invested, letting time do the heavy lifting. If you're a beginner, this approach gives you the highest odds of success with the lowest stress. You don't need to be perfect. You just need to be patient and consistent. If this video helped you, hit like, subscribe, and comment invest below. I'll see you in the next one.